we took the survey a year ago, inflation, recession, interest rates, biggest concerns that clients had. 12 months later, huge shift. Geopolitics, equity valuations, I'd add elections to that as well. Look, I think our clients are taking a couple approaches. Number one is just to continue allocating. 80% of the survey respondents said that they intended to allocate as much or more to alternatives in 2025 as they did in 2024. So despite all the uncertainty, they're not slowing down. I will say clients are being a little bit more cautious, particularly on the public side, right around the election. And they're basically in a little bit of a neutral policy from a risk perspective because it's unclear who's going to win right now. And there's very different outcomes between the two. And so I think privates keep investing, publics be cautious right now.
And let's talk about a few of the other takeaways in this survey. I thought it was interesting that many investors think that they're under-allocated to private credit. Two-part question here. What type of investors did you speak to for this and survey for this? And what areas in private credit do they want to get more into?
So really good question. We had 235 clients respond. 80% were LPs, 20% were GPs. It was global in nature, and it was institutionally focused in terms of who the clients were that we talked to. And the takeaway was what you said, private equity and real estate over-allocated, private credit, infrastructure, and secondaries under-allocated. And when you think about where clients want to get to from a private credit perspective, despite the fact we've been doing it for a long time, it's still relatively new relative to the others. And so some of the new areas of private credit would be asset finance, for example, that's growing very quickly. There's all sorts of strategies from mezzanine to direct lending to hybrid solutions, and we're seeing clients have interest in all of those strategies depending on what their risk return profile is. And so I think it's not one specific strategy in private credit, but it's really all of them depending on where they want to go.
What are the interest rate expectations or the changing interest rate expectations mean for that result? Because at this point, I feel like private credit's the only thing we've been talking about for the last 2 years.
Right.
A lot of companies are maybe having trouble making the payments, right, as interest rates went higher. And so we were hoping for some relief as interest rates come down. And now we're back to worrying about fewer cuts than the Fed has promised us to begin with.
Right. It's a great question, Matt. I mean, in 22-23, you had a great investing environment for private credit. And you were able to earn returns that we hadn't seen for quite some time. As you mentioned, rates have come off. And so, the spreads have come down a little bit in terms of what you can earn for the same loan versus a year and a half ago.
Spreads must be at all-time private credit tights. Right?
Yeah, they're tight right now. But we're still seeing, I'll tell you, we're still seeing investment opportunities that are quite attractive for us out there. There's a lot of deals that we're seeing, come across our desk. And we think there's going to be a lot of growth there still. I mean, there's a lot of innovation. Of all the asset classes, you're probably seeing the most innovation in private credit of all of them. And again, this asset finance business that I mentioned before is something that keeps sort of innovating and something that we're investing a lot of time in. We expect to be a big business for us.
Let's talk about shapes and forms of private credit for a minute here. Of course, Katie and I have been following a lot this idea of the ETF in private markets, investing in private credit, and among other things. But then there's also interval funds. There are these semi-liquid vehicles. How much do investors really want to get into private assets, which are illiquid by and large, into ways that are more liquid? Is there not a mismatch there?
Well, it depends on the type of client. And, you've seen a lot of growth in the last, call it 10 years, in retail-oriented vehicles for retail clients. And we spend a lot of time structuring those so that they, to your point, meet the liquidity requirements of the retail investor. And so, ourselves, we have a full suite of those vehicles out there for retail clients. And, on the credit side, which we've been talking about quite a bit, we expect those to scale pretty rapidly here in the coming years. But liquidity and structuring is always a big part of that because you have to make sure institutional clients have one set of things that they will accept. When you start talking about retail clients, it's a very different discussion.
They want their money back at some point.
They want liquidity. Everybody wants liquidity, it turns out. But the retail investors are incrementally focused on that, and so you have to structure for that.
There's 5 different things I could ask you. I picked one, though, and I want to talk about the competitive landscape. Of course, you just raised your fundraising target. It feels like everyone is raising massive amounts of money in the private credit space, but what are the deployment opportunities? I mean, what does the pie that you all are fighting over actually look like here? Yeah,
so it's very competitive out there, to your point. One of the things that we think is an advantage for us that I haven't talked about yet today is we actually have our private credit business housed within Goldman Sachs, and it sits right next to our investment bank. And so when you think about how we source and originate transactions, it's our asset management team on the investing side that's doing that, but it's also our investment banking team of 3,000 investment bankers out there every day. What you find is sitting side by side with the same culture, same set of incentives, playing on the same team, our private credit team often finds themselves in situations that are idiosyncratic to Goldman Sachs, can see loans early before others see them. So the funnel that we invest is more attractive, we believe, than others. And so we're seeing a lot of options out there right now.